Students, this video I wanted to record to give you some help with this problem from chapter 5 homework. This is the last problem on your homework for chapter 5, and it's problem number 11 in Connect, or it's also problem 5-6a at the end of chapter 5. So this is a problem on the concept of the impact of inventory errors on financial statements. I would like to, first of all, briefly remind you the rules. So here are the rules. If we make a mistake in the ending inventory by overstating it, then the mistake will continue for 2 years on the income statement, and then it will cancel out. So if you recall our inventory system, merchandise available for sale is divided into what's been sold plus what we have not sold. Ending inventory, which is on the balance sheet, and cost of the goods sold, which is on the income statement. So if I overstate ending inventory, I will understate cost of goods sold. If cost of goods sold is understated, then my gross profit is too high and my net income is too high, which leads to equity being too high. And of course, ending inventory is a current asset. So that one is leads to, and it's part of the current assets, so current assets will be too high. In the second year, everything reverses, and because the ending inventory is too high, the beginning inventory will be then, the cost of goods sold the second year will be overstated, gross profit therefore will be understated, and net income will be overstated. And again, if you don't correct the error for 2 years, it will zero itself out. The balance sheet items are not impacted for the second year, so there's no impact of the mistake for the second year. Now, alternatively, if we made a mistake understating ending inventory, everything reverses. Cost of goods sold is too high first year, gross profit, net income, current assets, and equity are too low. And then the second year, cost of goods sold is too low, and then gross profit and net income too high, current assets and equity are not impacted. So let me go back to the problem. So in this problem, we are Navajo company, and we have financial statements data below. The company discovered that in making physical counts of inventory, we made 2 mistakes. In year 1, ending inventory is understated, so we follow this pattern right here. Let me see if I can increase the screen a little bit. So that's what we're gonna follow. And year 2, ending inventory is overstated by 20,000, so we will follow this pattern when ending inventory is overstated. And there are 2 pieces of data you have to analyze, and I will just show the first piece of data, cost of goods sold. So cost of goods sold right here in year 1 was reported as 615,000. So I'm just going to copy this amount right here. 615,000. And year 2, it's 957,000. So these amounts are incorrect. That's what we reported. And year 3, 780,000. And then adjustment for year 1 mistake. So year 1 mistake, we understated inventory by 56,000. So when you understate inventory by 96,000, your cost of goods sold then was too high. So this amount, 615, was too high, and we have to subtract this mistake. So the correct amount appears right here. That's the amount that we were supposed to report due to the mistake, if we want to correct the mistake. And the second year, the cost of goods sold is too low. So because it is too low, I have to add the same mistake to the amount reported, and on the bottom you see the amount that is corrected. Year 3, there is no impact. The second year mistake, in year 2, ending inventory was overstated. So I'm following COGS, which means year 1 COGS was too low. So this was in the second year. Since it was too low, I have to add the mistake of 20,000, add it. So if it was too low, understated, I added. And second year, it was overstated, so I have to subtract it. Here you go. And so then you do the same for net income. You follow net income. And then the same pattern for current assets and equity. So I hope it helps. Have a good day. Bye-bye.